This is Daybreak Asia. We're counting down to Asia's major market opens, and the sentiment very much for the start of the trading week is one that's quite positive. We had US stocks inching higher to the Friday close, and the bet really coming from investors, Paul, that the Fed is going to be forced to start cutting, even though we continue to get that pushback from policymakers.
Yeah, a real disconnect between what the market thinks is going to happen and what the Fed says is going to happen. Most recently, we heard from Mary Daly talking about cuts being premature. But to your point on markets, yeah, they just keep on pushing higher. We've got the Nikkei now closing in on a record that we haven't seen for a very long time, Annabelle.
Yeah, really going back to the days of the economic bust, that bubble in the early 90s. But the open here for Japan, as you say, really the focus as well for markets coming into this week is what we get from the BOJ, because that policy decision is due on Tuesday. No changes expected in terms of negative rates or YCC, but the attention very much going to be on how Ueda, the governor, is assessing progress that's being made to achieving sustainable inflation. That's what's really needed to end negative rates in Japan. So all of the BOJ watchers in our poll, that's 51 different economists expecting the bank to keep its short-term policy rate at negative 0.1% and also to leave the program of yield curve control intact. The Japanese yen, ahead of that decision, continuing to hover around a 7-week low against the greenback here. But stocks-wise, that's one of the major beneficiaries. A weaker yen has been boosting the exporters, and you're seeing the Nikkei there up 0.8%. Let's change on, because in Korea today, we've also got that focus coming down to trade data, and we saw exports for the first 20 days of January actually falling 1% on the year. Interestingly, though, to note, we did get the chip exports, and they rose nearly 20% on the year. So it's something that is more positive for the outlook for semiconductors, given that we're starting to see those signs of an unevenness coming through into the market. Memory sales are stronger, but system chips are continuing to slide there. Imports as well, they were down more than 18% on the year. So Korea, a key economic bellwether, one of the first to report trading numbers, so seen as a leading economic indicator. We do see the Kospi there, though, continuing to push higher, so it'll be interesting to track how those chip names are faring, given, as I said, the NASDAQ 100 reaching an all-time high on Friday, Paul.
Yeah, it's information technology stocks that are performing best here in Australia as well. The ASX got a modest risk-on feel to it at the moment, better by 0.4%. We only see energy stocks, one of the few areas in the red at the moment, losing a little bit of ground. And Brent crude has just started trading. That's going, well, seeing a little bit of softness there as well, 78.33 a barrel there at the moment. Not a lot of change to the Aussie, sitting just below that 66 cents level. But if we take a look at yields here in Australia, they have been creeping up, and we've seen yields creeping up for US Treasuries as well. We've got the 10-year just started to trade in Japan at the moment, and we're seeing the yield moving up just a tad there, 4.1322, and we did discuss a moment ago those expectations around Fed easing. We've got the markets now pricing in roughly a 50-50 chance of a cut in March. We've had some more pushback, though, today from Mary Daly, San Francisco Fed president, who incidentally is a voting member of the committee this time around. She says cuts are going to be premature. Any talk of cuts getting a little bit ahead of the curve there, Annabelle.
Yeah, Paul, and that rate differential between the Fed, the BOJ, has been one of the more interesting dynamics to note as well for the outlook for the Japanese yen, also the outlook for Japanese equities, because it's one of the key reasons that's been cited for those pushing higher. So let's bring in our next guest, who's positive on Japan for the changing interest rate environment against a background of underlying structural reform. With us now is Kieran Calder, Head of Equity Research for Asia at UBP. So, Kieran, that BOJ rate decision is tomorrow. No change expected, and we've had sort of it being pushed back as well, these estimates. We would see some sort of policy pivot. How does that factor into your thinking for Japanese equities and their performance over the first quarter?
Yeah, good morning. So, we also think that we're unlikely to get any changes at the meeting this week, and of course the bias has been to keep the short-term policy rate negative. We've seen a little bit softer print on inflation, and that takes a little bit of the pressure off to change that in the short term. So, as you mentioned, the interest rate differential between Japan and the U.S. It remains unchanged in that sort of scenario, and definitely the weaker yen has been a factor in terms of not only earnings for Japanese corporates, but maybe more importantly for the correlation between the market, and they're a little bit different. We think that where the interest rate environment is at the moment, and we've got the sort of widening spread between 10s and the shorter term rates. That widening spread, although it's small, I mean, it's still Japan, we're talking about less than 1%. It's good for bank earnings, and so we'll be pretty focused on bank earnings in the upcoming result season, which is the fiscal third quarter for Japan.
And so when you have that sort of backdrop of a dovish BOJ, weaker yen, is that more important for Japanese equities, or are you more focused on what we're seeing in terms of corporate governance reform?
Well, I think we're focused on both. The changing interest rate environment is an economic reality that is happening. The corporate restructuring, corporate reform theme, it got a bit more juice when it was we had the JPX last year, encourage companies to get serious about it. We think that's a nice backdrop, and we hope it's for real this time. Of course, we had the first monthly list from the JPX published last on Monday, a week ago, which showed certainly amongst the large corporates and the prime market, a lot of 50% of companies have been defined as disclosing their plans to improve corporate value, which means rising share prices. But when you get into down into the standard market, the response is much less impressive. So there's certainly room to run in terms of that theme.
Well, we've got the Nikkei right now about 500 points shy of a record, but as monetary policy on both sides of the Pacific gets ready to shift, is there any temptation to take some profit here?
So for us, I think it's our preferred non-U.S. market. We're not looking to take profit yet. We think it's a great start to the year, obviously, but we do want to be selective in terms of sectors that we're interested in. So I mentioned earlier, financials is one area which we think underlying earnings growth is going to be strong against the backdrop of the changing interest rate environment. We also like tech in Japan, so we like some of the semiconductor names there, and also the platform names like Nintendo and Sony. And then we also think that with the cycle bottoming in terms of factory automation orders, we think there's obviously some highest quality, best in class names in Japan that we also think are areas that we're interested in as well. So to be selective rather than taking profits off the table.
Okay, well, you're quite constructive about Japan, but I know you're a lot more bearish when it comes to China. But at what point does China just get so cheap that you can't ignore it anymore?
Yeah, that's been the question for quite a while. So look, I think a lot of the problems in China are self-inflicted. So the crackdown on tech, the real estate. Even although it's a year ago, the response to COVID, I think all of these are still dragging on the market. And for us, ultimately, we think to get more constructive on China, you need to have a resolution to the property sector, and it needs to be comprehensive, and it probably needs to pull in the state-owned banks, et cetera. So valuation on its own is never a catalyst. I think clearly headline valuation is cheap in China, but there's so many reasons for that, and we think the most obvious catalyst for us is going to be a final resolution of the property sector. If that was easy, it would be done already, and we think it's probably not something for the first quarter.
Yeah, how long actually are you expecting? Of course, first quarter is incredibly optimistic. A lot of people are saying the economy is going to be in the doldrums over the first few quarters of this year at least. So when would you sort of start to price for any sort of meaningful pickup in the performance of equities?
So if you're referring to China equities, I think,
yes.
It could easily be first quarter next year. They've really, as I said, it's a large problem. It's difficult to tackle. They need to bring in, can't just be done by the real estate companies themselves. Obviously, we're way past the sort of self-help stage. And I think there needs to be a comprehensive resolution, including probably the banks, which is one of the reasons that they trade so cheaply. Maybe by summer. I think that's probably also optimistic. It's entirely on the timetable of the government in China, which is not so predictable.
All right, Karen Calder, Head of Equity Research for Asia at UBP. Thanks so much for joining us. Still to come, we will have a preview of this week's Bank of Japan decision with Moody's Analytics. Hear why they think the central bank could have a hard time raising rates beyond zero. But first, a major shakeup in the Republican presidential race. Ron DeSantis dropping out ahead of the New Hampshire primary. We'll have details of that story next. This is Bloomberg.
I am today suspending my campaign. I'm proud to have delivered on 100% of my promises, and I will not stop now. It's clear to me that a majority of Republican primary voters want to give Donald Trump another chance. I signed a pledge to support the Republican nominee, and I will honor that pledge. He has my endorsement because we can't go back to the old Republican guard of yesteryear.
That was Ron DeSantis announcing his withdrawal from the 2024 US presidential race and endorsing Donald Trump, who's now going to be facing off with Nikki Haley in Tuesday's New Hampshire primary. For more, we're joined by Washington senior editor Wendy Benjaminson, who's in New Hampshire for us. So, Wendy, it's an incredible turn of fortunes, really, for Ron DeSantis, who was once considered the most formidable challenger to Donald Trump. So what exactly happened?
Well, it was almost like until the U.S. Republican primary voters got to know him, he was the most formidable. There was this sense that he had a lot of the same attitudes as Donald Trump in terms of culture warrior, in terms of the border, in terms of, what they call woke, diversity efforts and things like that. And then he launched his campaign with this Twitter space that was an absolute disaster, all sorts of technical issues. He has this sort of, he's a little awkward in his presentation to people. They thought they didn't have to talk to national media, only Florida media. At the beginning, it was a badly run campaign. And so it was like, until he actually got into the race, it looked like he could win. And then he started talking and campaigning, and things just sort of went downhill from there.
Well, Wendy, it would seem that the natural home for DeSantis supporters would be the Trump camp. But are we now in a situation where the nomination is Donald Trump's to lose, or is there a path to victory for Nikki Haley?
There's a very, very slim path to victory for Nikki Haley, but it's so slim that I think it is Donald Trump's to lose, and that's what our reporting shows. If she wins Tuesday night in New Hampshire, then she would be catapulted to the next primary, which is in her home state, although Donald Trump is much more popular than she is in South Carolina. So if she loses that, even after a New Hampshire win, that would really slow her momentum or stall it. And the path just isn't there after that. She is going to do very well in New Hampshire because she has the support of Democrats and independents who are trying to stop Trump by registering as Republicans and voting for her. But that isn't going to happen in the states that follow. And so we really think right now it is Donald Trump's to lose, as you say.
So much of the focus has been on age in this contest so far, but really has been directed to Biden's age in particular. Donald Trump as well is someone who would be into his 80s if he were elected again. We have seen Nikki Haley stepping up her criticism and attacks on him, which is something that we also have seen a lot of Republican candidates being reluctant to do so far. How much do you think the attention will now shift to attacking Trump based on age and concerns that come with that?
Well, it's definitely a talking point that people are going to bring up, and he didn't help himself. I should say he is 77 years old now. He didn't help himself the other day when he seemed to confuse Nikki Haley with former U.S. House Speaker Nancy Pelosi. He has this sort of line he has about how she, during the January 6th insurrection at the Capitol, how she didn't call security quickly enough. But he told it the other night using Nikki Haley's name. And so he seemed to confuse the two women. That is being attributed, like, just as when President Joe Biden seems to forget things, it's being attributed to age and perhaps he's too old to be president. And, we'll just have to see. Trump does seem more physically agile than Biden does right now. But if he starts slipping up, confusing things, that argument won't last.
All right, Bloomberg's Washington senior editor Wendy Benjaminson in New Hampshire. Well, Israeli Prime Minister Benjamin Netanyahu has rejected what he says are unacceptable terms presented by Hamas to release its remaining hostages. Let's get more on this story from Bloomberg's Michael Heath. So, Michael, no appetite really from Benjamin Netanyahu to establish peace or even a ceasefire. What's the role of the domestic Israeli political audience?
Yeah, it's an interesting one, Paul. There's been a build-up of protests from the families of the hostages. I mean, they've been held for more than 100 days now. The last ceasefire was at the end of November, so again we're pointing towards another 8 weeks that nothing's really been heard from them. So there were protests on the weekend outside his private residence and then sort of setting up outside his official residence. And then he's come out and said that Hamas's demands are that Israel cease fighting and withdraw from Gaza. So almost like sort of a return to status quo before the attacks, which he says is totally unacceptable. From Israel's perspective, that's totally reasonable. But it's hard to see that it's that black and white, that's what any negotiation would actually involve. There is talk, though, that the Wall Street Journal was reporting that Egypt, Qatar, and the US are undertaking another effort at trying to step in with a phased outlook, diplomatic proposal whereby the hostages would be released, Palestinian prisoners would be released, and we'd end up with a ceasefire. Now, whether that goes ahead is unclear. Israel is prepared to accept, so the reporting shows, a 2-week break in fighting, whereas the Hamas leadership wants a lot more than that. They felt they didn't get enough, apparently, at the last ceasefire.
And then there's the actions in the Red Sea, and we've heard the UAE as well warning that time's running out now before this develops into a wider Middle Eastern crisis or Mideast crisis. Where is that flashpoint most likely to be? What's going on in Gaza or what's going on in the Red Sea?
Yeah, it's a good question, Annabelle. And I mean, we've seen in the past week that the conflict has spread. I mean, earlier we had this situation of Iran bombing an area in Kurdistan in Iraq that it says was an Israeli intelligence base. And then following that, we had Iran launch a missile strike on militants in Pakistan. Pakistan responding. It gets very scary then. Pakistan's obviously nuclear armed. Iran is a threshold nuclear power. Fortunately, both sides seem to signal signal that they don't want it to go any further. But there's been additional attacks on US forces in Iraq and in Syria by Iranian proxies. And all of this sort of, it brings Iran more into the frame. Now, Iran's always been keen to sort of avoid a direct conflict with the US. It's real cat and mouse shadow boxing between the two there. But this issue with the maritime corridor, it's very difficult to resolve. I mean, the US and the UK can keep targeting these missiles, but it's very difficult. They've interdicted one ship from Iran, but it's difficult to interdict the supplies regularly to stop the Houthis being armed, and there's no ground forces in there. So again, cat and mouse. The Houthis move their missiles or put them underground, these sort of issues. So it's a very difficult time now, and the Red Sea, it's hard to see how to be resolved soon.
All right, Bloomberg's Michael Heath there. Just got some breaking news across the Bloomberg at the moment relating to Macy's. Macy's confirming that it has received an unsolicited, non-binding proposal from Arkhouse Management and Brigade Capital to acquire all outstanding shares of the company, $21 per share. However, Macy's says this isn't actionable. They're not going to enter non-disclosure agreements or anything of the sort. Arkhouse, meanwhile, threatens to take this offer for Macy's to shareholders if Macy's doesn't step up negotiations. So that's the latest on Brigade's and Arkhouse's $5.8 billion, $21 a share that was made to the company last month. All right, plenty more to come on Daybreak Asia. This is Bloomberg. You're watching Daybreak Asia. Russia says Ukrainian shelling has killed at least 25 people near the Russian-controlled city of Donetsk. A local Moscow-backed official says the attack hit a busy market and a shopping area on the city's outskirts. Russia wants the UN Security Council to discuss the incident later on Monday, calling it a treacherous attack on civilians. The European Commission says Western allies must focus their efforts on stopping Russia's invasion of Ukraine, or Moscow will continue trying to expand beyond its borders. Speaking to Bloomberg in Davos, Vice President Valdis Dombrovskis warned that geopolitical tensions are posing fresh risks to trade.
It's clear that 2024 is going to be a challenging year, as we see that all the geopolitical conflicts are continuing. Russia's aggression against Ukraine, now conflict in the Middle East. So all this certainly has potential for disruption of trade and supply chains, even though the forecast for the growth of global trade for this year, according to the World Trade Organization, is quite positive. There's a forecast of 3.3% growth in trade, but certainly there are a number of risks which we need to follow.
Yeah. I know one of the biggest worries actually is the commitment to Ukraine aid. I don't know how much the Commission is prepared to go to make sure that also Hungary signs off on this €50 billion package.
Well, we are working very intensively on this, and on 1st of February we are going to have a EU summit where hopefully this agreement is going to be reached, because, well, we are already overdue. European Commission came with this proposal of 50 billion euros Ukraine facility already in June last year. We are already approaching February, and Ukraine actually needs this financing, so we need actually to take the decisions and provide this financing. And it's all the more critical that we also see delays on US side. They're also still discussing their financial support package.
Executive Vice President, when you look at some of the risks out there, and I know there's a lot of conflict, what do you worry about the most, or what's more likely? Is it Donald Trump in the presidency, in the White House? Is it far right, of course, outcomes in the European elections, or is it a full-on trade war with China?
Well, I would say my biggest worry is continued Russia's aggression against Ukraine, and if we are not containing this aggression, if we are not stopping Russia, the prospect of Russia actually going further and starting new aggressive wars. And they are very openly talking about this. If you look now on this Russia's so-called presidential elections, Putin is campaigning on a slogan that Russia's borders are ending nowhere. And what kind of signal it's sending to Europe, to neighboring countries. So Europe needs really to work very seriously to strengthen its defense capacity and provide all necessary support to Ukraine.
That was the European Commission Vice President speaking to Bloomberg's Francine Lacroix, and just taking a look at how markets are tracking here. Euro stocks futures pointing to further gains at the open. Euro weakness as well, stemming some of that recent slide.
Disinformation or misinformation and election interference is going to be a real challenge that we all have to tackle.
We are talking too much about Donald Trump in Europe, and we should prepare ourselves for a possible second term for Donald Trump by fostering our European competitiveness.
The best defense, if that's the way we want to look at it, is attack. And to attack properly, you need to be strong at home. So being strong means having a strong, deep market, having a real single market.
We've now got $2 trillion deficits with no end in sight. I don't know that the country, frankly, is prepared for 4 more years of that, because those things all poll very negatively.
And I think it's going to be a bumpy year, but more than anything else, we've got to be resilient. We've got to be prepared to react to news.
I think the path is probably that inflation's passed. They're going to start lowering at some point when they're ready. They're going to be prudent. They're going to be thoughtful.
They get 3 rate cuts in or more this year, as I expect it will.
Expect very probably a rate cut this year, but the question of the season is a premature one.
Some of the highlights from our conversations at last week's World Economic Forum in Davos. And a number of central bank decisions are due this week. We're starting with the Bank of Japan on Tuesday. Bloomberg Economics sees the BOJ likely to do nothing, stand pat, with Governor Kazuo Ueda maintaining a holding pattern until clearer signals on the size of the wage increases for 2024 start to emerge. Meanwhile, the ECB holds its first monetary policy meeting in 2024 on Thursday. President Christine Lagarde told us at Davos that the Central European Bank is likely to cut rates later on this year. Other rate decisions we're watching will be from Canada, Sri Lanka and Malaysia. Other economic data to note as well. In a few hours, we're going to get China's loan prime rates. And in the US, we'll be watching for data from the Fed's preferred inflation measure. That's on Friday, as well as fourth quarter GDP figures. All right, let's bring in Katrina Elnow, senior economist at Moody's Analytics. Katrina, a lot on the docket this week, but I do want to start in Japan, where we have that all-important central bank meeting. And no change, of course, expected at this meeting, but there is a sense of inevitability that we're going to see rates normalize. When do you see that happening?
Oh, definitely. So our expectation is that we will see a move in April. But I think heading into that April move, the communication and the transparency around the Bank of Japan's decision-making will be critical, because I think, they've had this ultra-accommodative monetary policy stance for quite some time. So now that we're talking about moving out of it, to make sure it's an orderly transition, we really need to see that clear communication.
Realistically, how far above zero can the BOJ go?
I mean, our view is not much, if at all, because at the end of the day, they've committed almost to moving away from this ultra-accommodative stance. But at the same time, the domestic demand environment is still so sluggish, and it's not showing signs of a revival. And at the same time, their external conditions as well are quite weak. We're seeing the export performance being sluggish as well. We're not expecting that to improve until the second half of this year. So we're not going to see a really aggressive move anytime soon.
What is your outlook for growth and consumption in Japan?
Yeah, that's a really good question. So overall GDP growth in Japan, we're looking at just a 0.1% expansion this year. So that post-pandemic revival has really faded in Japan. As I said, consumption is soft, private investment as well is soft there, and also that weak external conditions. So not a whole lot going right in Japan. So they will have to tread carefully when the central bank, does eventually move.
One area as well we've seen really consumers holding up, of course, has been the US, strong consumption. Lots of data as well this week, including the Fed's preferred inflation gauge. But what is going to be standing out to you most? And also that good news, or if we do see any good news, is that going to be something that changes any sort of expectations around the Fed?
Yeah, so it's really interesting in the US at the moment, because what we've seen is that the economy overall has just proved resilient on so many different fronts. And as you mentioned, the consumer is one of those areas that's been surprisingly resilient. And I think one of the key drivers of that resilience has really come down to the strong labour market. We've got an unemployment rate sitting still below 4%. It's been below 4% for 2 years now, so it's incredibly strong performance. And so we'll be continuing to watch the labour market, continuing to watch that cooling inflation environment as well, which is really setting up a really nice stage for these Fed rate cuts to actually come to pass. And at this stage, our money is on that May rate cut as kind of when the accommodative easing really starts to begin.
Where we can also expect possibly to see some sort of further easing is China. Policymakers perhaps have a little bit less room to wiggle in there, given that their rates are a lot lower. But what sort of policy support are you expecting this year?
So our view is that China is going to grow at 5% this year, but in order to actually get to that 5% growth, a lot needs to go right. And we do need to see that ongoing policy support, particularly on the fiscal front. And I think in terms of policy priority, what we will see is that the property market continues to get support from developers as well as home buyers as well. Because what we're seeing is that a more deep correction in the property market is manifesting in so many different areas of the economy and really causing weakness in domestic demand. So property market's going to remain a focus, but then on the other end as well, we're seeing other issues that are continually not being able to easily be resolved. And I think the clearest example would be that the high youth unemployment rate. So what we're going to see is that policymakers are continue to focus on areas like the labour market, in particular weak spots like high youth unemployment, because of the structural issues that causes as well.
Yeah, that's an important risk to note. Youth unemployment got reported again, this time with students stripped out, which is kind of understandable. So it's 14.9%. But does that sort of speak to perhaps a broader risk going on in China? This idea that of the social compact with the government, yes, you can rule undemocratically provided living standards keep getting better. Well, things aren't looking too good at the moment. We also have a contracting population. What's the path out of this for the Chinese government?
Yeah, it's a really good question, and I think it's a really difficult one, but I think they need to continue to make sure that there's sufficient jobs for graduates and really improve that environment, because social cohesion is so important to a successfully growing economy over a sustained period, particularly when you've got the backdrop of an aging population and, as you say, a contracting population as well. So continuing to provide that sufficient support for graduates, and more broadly from an economic point of view, if we don't continue to bring in the youth effectively and find jobs for them on a long-term basis, it does erode the productive capacity of the economy as well. All
right, Katrina Rell, Senior Economist at Moody's Analytics. Thanks so much for joining us. Still to come, scepticism over Chinese assets as well, spreading beyond stocks now. Investors expecting the yuan and government bonds to also underperform. We look ahead to the Monday Open up next. This is Bloomberg. Let's take a look at how we're doing on markets in the Asia Pacific. The Nikkei about 500 points away from recapturing that high that we have not seen since 1990. So another positive day for the Nikkei, better by 1.4%. Of course, the yen is extremely weak right now, which is a bit of a tailwind for stocks. 148.11 at the moment against the US dollar. Here in Australia, we're in positive territory as well by about 0.7%. The Kospi just turning flat after a rather soft start, and some gains for New Zealand as well. And of course, this follows on from a positive session for US markets. All of the major indexes closing out on Friday better by 1%. Chinese stock bulls will be hoping for a better week ahead when trading starts in the next hour. A gauge of mainland equities listed in Hong Kong languished last week at the bottom of global index ratings for the year so far. Admittedly, the year only 20 days old. But for more on this, let's bring in Asia Stocks Managing Editor Lianting Tu. So, Lianting, how's trading looking for this week?
Yeah, it doesn't look very bright. If you look at the Golden Dragon performance on Friday, when U.S. stocks ended day at record highs, Golden Dragon was still down slightly. That really is quite telling on investor sentiment, the kind of intense bearishness that we're seeing. And indeed, I think we've entered a period where bearishness is just so fierce or intense that investors are only focusing on negative news right now. We did have some positive news recently, such as the $1 trillion yuan special bond, I should say, and Ping An's support list of 41 developers. But market didn't bounce at all. We haven't seen that type of lack of reaction for a very long time. It does seem like investors start to discount all the good news because none seems to have shown up in the economic data so far. And we're seeing deflationary pressure intensifying and growing skepticism on the GDP figure as well. So yeah, I think we are looking at even more grim milestones for this week for the HSCEI to maybe hit the lowest since 2005 and for the Hang Seng to hit the lowest since 2009.
Yeah, so it's probably no surprise then that we're continuing to see bearishness in the yuan, government bonds, and something that's likely to persist.
Yeah, I think it's indeed spreading. The idea is for rates and FX in China, compare with other emerging markets, China has already cut rates and did a lot of easing last year. So China's monetary authority has much less room to cut again than its major global peers. And that is really going to put some pressure on the yuan and limit the upside for Chinese bonds. And for bond investors, they're also looking at the strength of the yen. If the yuan weakens, I should say, and then that their overall return on Chinese bonds will be reduced as well.
And then how is the rate outlook for other countries also playing into the attractiveness of China debt?
Yeah, I think people, of course, are really factoring in some kind of rate cuts in the U.S. Maybe not 5 times, but maybe 3 times. But still, the consensus expectation is for a slew of cuts coming through, and also for other emerging markets like, for example, Indonesia and Brazil. Their rates are at relatively high levels, and some investors are already saying that they prefer those markets where rates have been elevated versus countries like China, where a lot of cuts have been done. So the upside is really more limited for Chinese government bonds right now.
Yeah, very interesting. That was our Asia Stocks Managing Editor, Lian Ting Tu. And, of course, the performance of Asia EM stocks, pretty interesting to note last week, excluding China, of course, but we did see some big outflows, given that investors had sort of been recalibrating once again their expectations around the Fed. But let's discuss that now. We've got Abhishek Vishnoi joining us from Singapore. He's our Senior Asia Equities Reporter. So, Abhishek, not a great performance, as I said, for Asia ex-China rather last week, but something you're saying perhaps could be a little bit more of a blip rather than a trend that's starting.
Yeah, definitely. I mean, it doesn't look like a trend at all because this was the first outflow after, 10 weeks of inflows. And, the outflow has been led by Taiwan and India. If you look a bit more granularly, I mean, Taiwan's outflow came right after the vote. But half of that got retraced as TSMC delivered a solid outlook for growth and capital spending. So, Taiwan's outflows are already reducing. And then comes India. We just seen outflows on back of bellwether HDFC Bank's results showing some sort of slowdown in loan growth. But that is also dissipating. The result season have just started, and it started on a very positive note with tech companies delivering better than expected numbers. So, given the context of outflow coming for the first time in 11 weeks and this whole setup and optimism around earnings, it does look like a blip. If you look at MSCI Taiwan and MSCI India relative to MSCI Asia Pacific Index, both the markets are seeing significant upgrades, earnings upgrades this year, while for MSCI Asia is trending lower largely because of China. So, earnings are not disappointing, so should inflows.
We have seen the US dollar, or the Bloomberg dollar spot index at least, appreciating pretty sharply so far in January. What sort of impact is this going to have on emerging Asia?
Well, the dollar index obviously have a negative correlation with all sort of risky assets. So, that is definitely in play. The broad setup for not just equities but risk assets across the world is whether U.S. going to see a soft landing on back of, the much talked about aggressive rate cuts by Fed. So, that narrative is at play. But, if you look where U.S. market is, overnight, expectations of cooler inflation have, once again taken some of the gauges to record highs. And you look where MSCI EMX China is, I think there are more people, more bulls in the camp who are hopeful that the soft landing narrative would prevail sooner than later. So, keep an eye on dollar index. But at this point in time, from what we are getting from our reporting, from what you're seeing in terms of market positions signaling, it does look like that it won't be a big threat for risk assets, including Asian emerging markets.
Yeah, and something as well that we're really seeing playing out this morning, that dynamic around the Fed. That was Bloomberg senior Asia equities reporter Abhishek Vishnoi joining us there from Singapore. We'll have more ahead on Daybreak Asia. This is Bloomberg.
We don't want to loosen policy too quickly, only to find that inflation gets stuck at way above target. That would be a miss. That would be a very scarring miss. And we don't want to try to get to 2 so quickly, like overnight, just to get that squeezed out, that we end up having this big run-up in the unemployment rate.
That was the San Francisco Fed President Mary Daly continuing to push back on these market expectations for Fed rate cuts early in this year. But the trading dynamic we're seeing so far in Treasuries this morning suggesting that there is conviction that the Fed is going to begin reducing its benchmark rate as soon as March. So certainly something to keep tracking. We are seeing, as I said, those moves across the curve here and continuing to hold above that 4% level. That dynamic of high yields, the Fed, is certainly something that's been weighing on the Hong Kong property market, given the Hong Kong Monetary Authority follows what the Fed does as well. But what else is really shaping the dynamic of the real estate scene here in the city is Chinese developers that really once expanded aggressively in the city. They've now retreated from Hong Kong instead, with that unprecedented downturn in the mainland economy. So for more on that, let's bring in our Asia investing and real estate reporter, Crystal Chia. Crystal, is this sort of a permanent shift that we're seeing here in Chinese developers in the city, or do you think it's something that's more shorter term or even mid-term whilst they wait for that sort of recovery in mainland China?
I guess that really depends on how fast and how well mainland developers can recover. So far, we are seeing that even with a lot of government help, these developers are still struggling to pay debt and consumer confidence is low. I mean, what's for sure, though, is that the landscape has really shifted. In 2018, we are seeing mainland developers actually telling Hong Kong developers, get used to this record land bidding prices. And right now, we are seeing their presence in the city significantly fade.
So what's this going to mean for Hong Kong's property market?
Well, it could mean that the Hong Kong developers, they would have more market sway, so they might be able to better control how the market is going to be like. I think one thing to caveat, though, is that it doesn't mean that the picture is any rosier for Hong Kong developers. Residential sales are low, in the commercial scene, developers are struggling to find tenants. So it really depends on how they set prices and how they want to collaborate with each other in JVs potentially to see how they want to navigate out of this prolonged market downturn.
That prolonged market downturn, though, for Hong Kong, I mean, we're seeing it really evidenced because rents continue to be low. We're seeing landlords as well that can't sell their properties. They're putting them back onto the market again to lease. As you said, commercial properties, we're looking at office blocks around us that don't have any major tenants as yet. What's going to really shift the dynamic? And is there a question really of oversupply in the city as well?
Well, in terms of the rental market, I think what's going to shift the dynamic is really the influx of mainland Chinese nationals. So a lot of them have come under various talent schemes that the government has put out. So that's one thing for rent. I guess for the residential market, we have seen the government introduce a series of measures to encourage buying, such as for those without permanent residency, you don't have to pay the stamp duty right now. And right now we are still, we're still in a wait and see attitude to see whether those measures will actually have any impact. And for the commercial sector, I think it really depends on the performances of the businesses. At the end of the day, Hong Kong is seen as a gateway to mainland China, and if the China slowdown continues, these companies, they might not be able to lease bigger and better offices eventually.
All right.
When it comes to the property market, though, for I said oversupply, I really meant for the office market. I should clarify that. But when it comes to the residential side, do you think that there's got to be any sort of meaningful change of expectations from property owners as to the actual value of their property? Because sometimes it can be a case that that people really cling to prices that we saw, as you said, back in 2018, even earlier.
Well, sadly, for property owners, the outlook by most analysts this year is that residential prices will continue to drop. Nowadays, property people, in fact, in Hong Kong, instead of buying property, they choose to rent. And that's not good for those who are trying to sell their property. And of course, the bigger trend is, as we have been reporting for the last few years, people moving out of Hong Kong. And that, again, decreases the available population for buying these properties.
All right, Asia investing and real estate reporter Crystal Chia there. Thanks for joining us. Let's take a look at some of the stocks to watch when the market open does get underway in Hong Kong and mainland China in a little bit over 30 minutes' time. Keep an eye on battery makers, specifically CATL and BYD, following a new US rule that will ban the Pentagon from buying batteries produced by China's biggest manufacturers. That ban would potentially begin in 2027. Let's take a look at how we are doing on the markets here in the Asia Pacific. In a nutshell, very much a risk-on day, and the Nikkei once again having a very strong session, better by 1.5% right now, and helped along in no small part by an extremely weak yen, 148.12 against the greenback at the moment. And another point to note for the Nikkei, we are now just about 400 points away from eclipsing a record that we haven't seen since back in 1990. Kospi, meanwhile, that's also in positive territory after a rather sluggish start, better by 0.1% here in Australia. Meanwhile, Annabelle, we are also in positive territory by 0.7%.
Yeah, well, Paul, I think moving to the downside or in the other direction has really been Chinese equities, because we've seen more than $6 trillion of value now being erased from the peak back a couple of years ago. So really a big focus for investors is whether we can start to see any sort of sentiment shift. So far, the outlook is looking a little bit rosier, but as I said, you've got to put it in context here, because we did have a very dismal week. A gauge of mainland firms listed in Hong Kong languishing at the bottom of global equity index rankings for this year so far, but still ahead. We'll speak with Allianz Global Investors to discuss the rate policy outlook in Asia. Plus, we get an outlook on Chinese equities with Foundation Asset Management. That's it from Daybreak Asia. Our coverage continues.